Welcome, guys, to the first Buehler breakdown. I'm here with the one and only Shane Sharp with Fairway Home Lending.
Thanks for having me, guys.
Thank you. So we're going to dive right in. Okay, guys, we're going to dive a little deep on some of these topics. I posted onto my Facebook here just recently, polled you guys. I wanted to see what questions you guys had, comments, concerns, what things you wanted to know about the home buying process. Just from had a lot of activity. I appreciate all the input, guys. Looking like most of the questions we had was on more of the lending side of the business. So I called my buddy, one of the best lenders in the business, Shane Sharp, in to kind of answer some of the more detailed questions that you guys had. So like I said, we're going to dive kind of deep. So this is going to be quite a bit of numbers, a lot of information. We're going to break up and do some more of the actual purchasing of homes, inspections, that sort of thing in a later podcast. We'll probably put some links down and let you guys know when that's going to be coming up. Probably plan on next week. But let's go ahead and start off. I'm going to ask Shane some questions here. So when you look at buying a home, I think a lot of people assume, not necessarily rightly so, that the actual process of buying a home is pretty simple, that the complications, especially for millennials, for first-time home buyers, that the confusing part is the lending. So we're going to really kind of break this apart into a few different segments. But like I said, let's go ahead and dive in. So Shane, I know you had said earlier when we were talking before off air that you kind of break this down into the three pillars of lending. Kind of give us an overview of what those three pillars are, and we'll kind of break them apart as we move forward.
Yeah, absolutely. So there's lots of different programs out there, lots of different ways that you can take a loan. Essentially what it all kind of boils down to is there's two government entities that oversee the mortgage industry, and it's Fannie Mae and Freddie Mac. So if anybody's seen The Big Short or ever turned on the news and or read a textbook, you've probably heard of those two, Fannie Mae, Freddie Mac. They basically oversee the mortgage industry, and they set up all the guidelines and everything that we have to follow. So basically what it all boils down to is there's three main sections that us as lenders have to look at. So it's credit, income, and assets. So credit specifically, what is your credit score? What does your credit profile look like? Credit history. Assets as far as what do you have for down payment? Where did that money come from? Where can it come from? How much do you want to put down? And then income is going to look more at, what is your employment? What is your debt? What is your debt to income ratio? Things like that.
Okay, perfect. Now, let's start with credit. We're going to talk about credit and assets first. With credit, you hear a lot of people, what's my credit score? You can go to the websites. What reports do you guys actually pull, and what bureaus are you looking at for credit scores?
Yeah, great question. So every mortgage lender is required to pull all three credit bureaus. Okay. So we all know about Equifax with the exciting breach that happened. Yep, there we go. So there's Equifax, Experian, and TransUnion. Every lender has to pull all three for mortgages. So, and you can think of it as every time you purchase any kind of a debt or you apply for any kind of a debt or liability, they're looking at the likelihood of you paying back that money for each given transaction. So there are different reports for everything. So if you go and you buy a car, they're rating what is the score, the likelihood of you paying that car back, right? And it's going to be a different likelihood for an auto loan versus a mortgage. So there's a mortgage, because of that, there's what's called a merged residential mortgage report. And it's a different report, so you get a different score with a mortgage than you would with an auto loan.
Okay, so I can't go down to Ford and look at trucks and have them pull my credit to qualify for that loan, and that's not going to carry over to you guys.
Same ballpark. It's just not.
But it's not going to be the actual number. So if you hear that's the report, don't go running around saying I have a 805 credit score just because Ford Motor told you so.
You can do it. Make yourself feel good on Facebook. But yeah. Okay. A really common question I get is Credit Karma. I personally use Credit Karma. It's a great tool. It's free. It's awesome. You guys go do it if you don't have it or don't know about it. But Credit Karma, Equifax, Capital One, all your banks, they all use credit monitoring services that guesstimate what your credit score is based off of a consumer level report. Okay. So it basically kind of does a ballpark number based off of everything, and we all know that if you try to be everything, then pretty much just suck at everything, right?
Yep.
So, so from that, it's a good guesstimate. It's a great tool to monitor your credit and activity, but it doesn't tell you accurately what your score is.
Okay. So with that accuracy, what are the thresholds? Let's kind of run through some of those, because I know, your VA qualifications, your FHA, and your conventional loans, we'll talk about those here in a little bit as well. But each one's going to have a different threshold for what credit score they will allow as like a minimum credit score. So let's start there and work forward. So
yeah, and there's kind of two conversations, three actually. So there's one, there's the ideal credit score, which is where I feel it makes sense, and that's where having a mortgage advisor or someone that knows what they're doing to say, okay, based off your specific goals and what you're doing, this would be the best score, right? So there's the ideal score for a given program, and then there's a minimum score. So just because it gets you in the game, that doesn't mean it's best for you. It gets you in the game, right?
True.
And there's an exception, kind of a gray area, exception basis. So the minimum on paper is 600 for most loan programs, 600 plus. So most government loans, VA, FHA are 600 plus, whereas conventional is technically a 620 plus, so 620 score or higher.
Okay.
So these are just minimums that we're talking about, right? Minimum
Absolutely,
scores.
just minimums.
Okay, cool. What if I have a 500 credit score? I'm never going to get in a house, right?
Yeah, that was going to be my next question. Okay, I was, college, I racked up credit card debt, and I was late on a couple bills, and my credit score is down in the 500s. Yeah, I can't get into a home. What steps can somebody take right now to be proactive and start that process to start rebuilding credit?
Yeah. So this is where I think everybody's going to want me to tell them like the magical
the magic bullet. What is it?
To fix it. Like go to this website, go to Credit Karma and fill or open up this credit card. There's really no easy answer to that.
Okay.
What I recommend, and by the way, I'm not affiliated with any kind of credit repair company. I get no kind of kickback or anything like that. I refer people to them because that's what they do all day. I do loans all day.
Yeah.
I know how to do loans really well. You do real estate really well.
Yeah.
People that work on computers all day, I never want their job. They work on computers. So people that repair credit that we refer them to, that's what they do. They know specifically. They take the guessing work out. I would say if you had credit challenges in the past, do not try to do it on your own. I promise you, 9 times out of 10, you will do more harm than good. I know us millennials think that DIY, we can do it better than anyone else through Google. It's a magical thing.
I saw it on Pinterest.
How to fix your credit, 10 days.
I clicked that Facebook ad.
Yeah. So paying off collections, I'm not saying don't pay your bills, but paying off collections that pop up, if you don't do it the right way, it can hurt your credit. If you think you're doing the right thing, it can hurt it. Paying down credit cards, sometimes you might not be using best use of your money. So I look at it as case by case. The reason why we offer a free credit analysis, even if you have a 400 credit score, is I'd rather take 15, 20 minutes of my time to coach you on how to get in the right track and which direction to go than you blindly going out and do it on your own.
Absolutely.
So that's what I would recommend. If you're at a 580, if you're within a few points, a lot of times we can rescore your credit to get it higher, or we can actually get an exception on a case-by-case basis within about 10 or 20 points from the minimum number to get you in the game.
Okay, yeah. So, I'm starting this process. I'm going to go to a lender, and they're going to pull my credit. So that's kind of that first pillar that we talked about. But, I'm worried because if I get my credit score pulled, it's gonna dock my credit. I'm going to lose 20 credit points. Is that right?
It's actually 55.
Yeah, it's 55.
Probably the most common objection that I get when we're starting the process. So it basically the stronger your credit is, the less it affects your score, and the quicker it rebounds. The lower your score is, the more it's going to affect your credit.
Okay. And give us a ballpark. What is that?
Yeah.
Worst case scenario, best case scenario, what, 1, 25, what kind of?
I'd say worst case scenario, if you have a 500 credit score, which remember is going to be the biggest hit,
yeah,
you're talking maybe 5 points.
Okay. So
if you have a 750 credit score, you're talking 1 to 2 points.
Okay.
And it'll rebound back within the next 3 months, and it'll be pretty much go away. So
it's a non-issue.
It's a non-issue. People make it out to be a big deal. Now, that doesn't mean go and apply for 10 different credit cards and a bunch of different car loans and 10 different mortgage companies. It's going to hurt your score. But we're going to do it strategically to give you, get you on track. If you do it the right way, you shouldn't need to go out and have your credit pulled that many times.
Okay, so yeah, it's not gonna be the death blow. You're not gonna see a
Right.
huge drop in credit
Right.
in your credit score. So let's talk a little bit. We talked about credit, kind of those minimums of really 600, 650 really kind of sounds like more of that safe zone for where you would like to be at ideally to purchase a home. Is that kind of where you?
Yeah. If I can get my buyers up to 680, then they're in very, very good shape. Top tier is 760 plus 760. But again, if you're over 600 or you're close, you're in the game. We can get you a loan. Now it's just a matter of how much time do we have? How early can we have a conversation so I can coach you on the next steps to get that up as high as possible?
Absolutely. So let's talk a little bit about assets. Assets versus debt. What does that look like? We're going to move into, here in just a second, we'll talk a little bit more about debts because I know that's a big question for a lot of first-time home buyers. Really, anybody probably under the age of 35 to 40 probably has some form of student loan debt. So that's going to be kind of a topic that we're going to talk about here in a little bit. But let's first talk about assets. So I'm going to come to you. I'm getting qualified for a loan, starting the process. You've run my credit score, 750 credit score. So I'm doing great. What assets can I use that will qualify and go towards my income, if you will, for that ratio that we're going to be talking about here in a little bit?
So the assets are referring to down payment, right?
Correct.
Okay, gotcha. So assets, great question. So what sources of money can we use for down payment to go towards down payment, right?
Yep.
Okay. So let's see here. You can get a gift from a family member that we are going to source. Don't deposit any money yet, but we're going to talk. I'm going to walk you through how specifically we get the money in your account. But you get to have that fun, awkward conversation with your great aunt or your grandma or something, or your parents, to get a gift from them to go towards closing costs. That's acceptable.
Okay.
There's no limit to that.
I have to pay that back, right?
You cannot pay it back. It's a gift. So it's not a loan. It's a gift. It's out of the graciousness of your parents or your grandparents. They're giving that to you. That's the one stipulation.
Can't pay it back.
Can't pay it back. So that's the first one. A lot of people don't know about that. Of course, you can use checking and savings, anything that's in your bank account. Biggest thing is anything that you can't. Main thing that you can't use is any cash money, like what we call mattress money. You can't really use that money. We can't see it within 60 days before closing. So if you have a bunch of cash, you're not going to jail. It's a conversation that we need to have to make sure I can get you on the right path to be able to use that.
Okay.
The most common one that I see right now is 401k loans and IRA loans. So you can actually take a loan against your retirement accounts, and don't know if you want me to go into detail.
Talk a little bit about that. Okay. I know I have some friends who are currently looking. They have Roth IRAs, they have 401ks set up. That's kind of where a lot of their savings are going right now. So
yeah.
I'm sure that's something that that information-wise they'd love to know. What does that look like? How can you structure that? How much of that can you use? Does that money have to be pulled out?
For sure. So everybody thinks, I know we've always learned through our parents and through society and media, like, don't touch your retirement. It's the worst thing you can do. I'm not advocating that you go and liquidate your retirement funds and pull your money out of the stock market to buy a house. Terrible idea. Don't do that. There's lots of tax penalties and capital gains and early withdrawals. We don't want to do that. What we're talking about is totally different. It's a loan against those accounts, completely separate from us. It's through your agency that manages those funds. So if your employer offers Fidelity or TD Ameritrade, whatever it might be, you're going to take a loan from that company. And it's not like a mortgage. It's super easy to do. It takes 5 days. You type in what you're buying it for, and they approve it within a couple days. It's really easy to do. I always recommend to reach out to them to get the details of that. That's something that I can coach on a case-by-case basis. But essentially on there, what you can do is you can pull out typically up to about 50% of whatever you have in that account. And same thing with stock accounts. If you have a true brokerage account, I know you invest in the stock market as well.
Correct.
You can take out margin lien against that as well. So you take a loan out against that. And the great thing about it is it's such low interest on there. It's low risk because the actual company that manages those funds, they have the funds in their account. They have no risk.
Yeah, that money's not going anywhere.
Yeah, the market tanks. Let's just say hypothetically, the market tanks. They still have their money because it's 50%. It's good, right? So that's the benefit of that. A lot of people don't know that. There's certain limitations and things like that. But for a lot of my first-time home buyers and second-time home buyers, we're able to use that as a solid vehicle to borrow that money.
Okay. So talked a little bit of assets. Now, a big question that a lot of first-time home buyers, it's going to be down payments. So 5% down, 20% down. Everybody I talk to, they want to put 20% down because that was the age-old, put 20% down when you're buying a house. That's the way it is. Put 20% down.
Yeah, that's what our parents did, right?
Yeah, that's what they did.
Didn't have an option.
Yeah, exactly.
So, definitely don't have to put 20% down. I would probably say, I'd even go as far as to say 50% of the buyers that I work with put 5% or less down. 50%, 5% or less. I'd say maybe 20% put 20. I'll say 25% put about 20% or more down. So a very small percentage of people are putting less than a quarter. People are putting 20% or more down. So it's because money is so cheap to borrow right now, and I'd much rather have, and a lot of financial advisors feel the same way if you talk to them, that they'd rather have you keep your money in the market to make you money and work harder for you versus having it tied up in such a low-cost mortgage on the house. So as far as how much do you need to get in the game to put down payment, it's ranging anywhere from 3% to 3.5% or 5% down for the minimum options.
Okay. And 0% for our veterans out there with
0% veterans, absolutely.
Yeah. All right, so let's kind of move back into, we kind of got away from that income to debt ratio. So explain income to debt.
Yeah. So this is the third and final
third pillar.
Right?
Yeah, this is the big one for a lot of people because they ask, what can I qualify for? And I think a lot of people, when they get that first number back of what they can qualify for, it's a little shocking.
Yeah.
In the opposite direction that you would think. I mean, a lot of times you qualify for probably a much bigger mortgage than I think even a lot of people would be comfortable qualifying for.
For sure.
Because then you start to break down that monthly payment and you look at that and it's a little crazy.
Yeah.
I know when I bought my first home, for $150 5-6 years ago now, and I think I qualified for $250 at the time. And of course, this was 3 years out of college, and I was looking at that going, wait, you want me to spend $2,200 a month? No, that's where? What money are you talking about?
It's crazy.
Yeah, it's nuts. But I always advise my clients, get pre-qualified, obviously, before you start the process, just so we know what kind of homes you can be looking for. Do you talk with your clients about maybe not looking up to the peak threshold of what they qualify for? And then kind of talk about loan to debts, what that looks like, what you guys look at to factor into what they can qualify for.
Yeah, absolutely a discussion that we have. And that's probably, especially with first-time home buyers and, our millennials, millennial friends that are buying and things like that, it's going to be really based off of, there's two numbers. There's what does the government say I can qualify for? What's the max number? That's exciting. Frame that, put it on Facebook. Yeah, I could buy a $600,000 house. I'll eat ramen noodles and I'll never be able to turn my electricity on.
Yeah, and I'll sit on a yoga mat in the
sounds great.
living room.
Yeah. Or back to reality, back to my budget. Okay, maybe my budget is a $300,000 house or $250,000 house, whatever that is, right? So those are two separate conversations. And I always start with what's the max you can qualify for to put that as a baseline. And what I've found is just like you said. I mean, most people are shocked at how much they can purchase. Some people don't have good expectations and they have hurdles with income, and that's something that I'll coach them through too. But a good ballpark number. So don't quote me on this. This is a ballpark number. Okay, if you take your income before taxes divided by 2. Okay. That's typically what all of your debt can equal.
Do you guys have pen and paper out right now? You're writing this down?
Yeah,
Divide
quoting
by 2.
per Shane. Shane says, write me a prequel. So if you take your income before taxes, so let's say you make $50,000 a year, right? So let's get out our calculator together here. So if I make $50,000 per year and comes out to a total of $4,100 per month. So $4,160 per month, right? So if I divide that by 2, all of my debt cannot exceed about $2,000 per month.
Okay.
So I have $50,000 salary, then that's about $2,000 per month is a max amount of all my total debts.
Okay, and what debts do you guys factor? Are you looking at my utility bill? Are you looking at what I spent at the bars last month? What factors into that debt for that $2,000 a month for somebody making $50,000?
So you're safe at the bars. We won't have to look at. Yeah, you're good there.
Don't cut into my bar fund.
It's just going to be anything basically that shows up on the credit report, which is going to be student loans, credit cards, or what we call installment debt. So any installment debt is going to be anything that car loans, if you have any kind of basically loans with a balance, furniture loans or things like that.
Okay.
Anything you have a balance on that you make a set amount every month until it's paid off.
Second mortgages if you have a rental property.
Yeah, anything like that.
Okay.
So any of those, any utilities, cost of living, anything like that. Remember we said the actual number is 45%, just for the record. 45% is the max debt to income ratio.
Debt to income, okay.
Y'all are ballparking this, we'll say 50%.
Yeah,
easier math,
makes
right?
easier math.
So the other 50% or 55% is going to go towards cost of living, taxes, utilities, the bar bills, other stuff that you guys do to cover that. And then they figure the rest is to go towards those. Basically anyone that's going to come knock on the door and tell you, hey, you owe us money.
Okay.
Yeah.
Now let's dive a little bit deeper. I know we're talking first-time home buyers for the most part, but this kind of spurred my interest. So I have a rental property down in school that I went to. It's currently being rented out. How much of that rental income can I apply towards that debt if I were to go get qualified for another loan? What does that look like?
Yeah. Paraphrasing guidelines here. That's it. That's a little bit more of an in-depth question.
Ballpark again.
Ballpark, typically you can actually completely cancel out the debt per qualifying purposes.
Okay, so as long as my mortgage is being covered by my rental income, you can cancel that out.
A lot of the time.
Most of the time in most situations. Okay.
I'm giving Nash the evil eye for putting him on the spot. But yeah, a lot of times with my investors that I work with, we're able to structure it to where if you have a $1,000 mortgage on a property and you have $1,200 of rental income, that's pretty much going to cancel out as if you don't have a mortgage there. Which is pretty exciting because it used to be where you had to put that in.
It was like 75%. Where
75%, then adding your income, so 50% of that. So you're only basically covering like 50% or less of your rental. But pretty exciting, they're actually able to cover the full amount now. They changed the guideline on that.
Okay. So, I mean, a big question, obviously. Now we're going to get kind of back into more of the first-time home buyer. So a big question I had, I got asked this multiple times when I posed the question to Facebook was, how does student loan debt apply towards qualification? It sounds like it's just basically the same as credit card debt, or what your monthly credit card bill is going to be, or what your car payment's going to be. There's no difference between those, correct?
So, correct, yeah. It all comes out the same. So it goes off of what the minimum payment is on, like minimum payment for credit cards. That's great that you bank $100 extra over payment, but it's just the minimum payment. Same with student loans. If your minimum payment is $100 a month, but you make $500 a month to pay it off faster, good for you. That's not going to hurt you. We're just going to use what the minimum payment that's listed on the report or the student loan statements are.
Okay. And obviously, I mean, this is something I advise all clients. Again, I'm not a financial advisor, but common sense states, guys, get the student loans paid off. I mean, most of those, the ones I had were 8 to 9 to 10%, just crazy interest rates.
Yep.
That would be my first. If you got to make double payments, what do you got to do? Get those out, because you're just burning money.
Agreed.
So I would say that's the first ones you want to get off. Credit card debt, again, do what you can. Don't be carrying a huge credit card balance, because it's just not good. But so roughly what we're looking at here is 50% of your monthly take home prior to taxes and FICO being taken out, correct?
Right.
Perfect. So that was good. So loan programs. Again, so first-time home buyers, FHA, conventional, VA, what does that look like for Joe Blow off the street, first time, this is the first home, he's 5 years out of college, what program should he look at?
So I will tell you what most people do. After I precurse that with, there is no one size fits all.
Exactly.
There is no best option for every person ever. It really depends on I mean, listen, guys, if my job was as good as, everybody gets this loan, I wouldn't have a job.
Yeah.
Computers would replace me yesterday.
Yeah.
So we really look at what their goals are, what the specifics are of the situation. So I'll tell you what most first-time home buyers do is they look at 3.5% down FHA loan. That's typically what they do. It's going to be more lenient on guidelines, more lenient on debt-to-income ratios. We can get some exceptions on that. And also on credit score, it's more forgiving for lower credit or if you have any credit challenges. So there's just more options there.
Yeah.
So that's what most people, first-time home buyers, typically lean towards. And then also, typically it's 5% down for a conventional loan. We actually have access to a 3% down conventional loan option.
And that's a new program here within the last year or so, correct?
Yeah, about the last year.
Yeah.
So
great program. I like that.
very good, yeah. And actually, typically you think, okay, I'm putting even less down. My interest rate's going to be higher. My PMI is higher. Actually, I'd say the majority of the DFW, you do have to qualify for, there's different limitations for income and different property limitations. But the majority of the Metroplex, I can find a program with that 3% to get you a really, really competitive rate and low PMI as well. So yeah, I would say if you have anywhere between 3 and 5% in any of those ways that we talked about, the gift, checking savings, or the 401k IRA that we could tap into, then you could get into a house in that option.
Absolutely. Okay, so PMI, big question. Okay, so I decided I'm not going to put 20% down. So now I'm getting hit with this thing called PMI. What PMI? Break that down for people.
Yeah, so
using some mortgage jargon over here.
Yeah, PMI, I'm sorry, I dropped it, didn't even know it. So private mortgage insurance is what it stands for, mortgage insurance. This is not your home insurance. This is not your State Farm, Allstate, to protect your house from a fire or theft, right? This is mortgage insurance. So this doesn't protect me, this doesn't protect Fairway, this doesn't protect you, unfortunately. This protects the government.
Protects Fannie Mae.
Protects Fannie Mae, Freddie Mac, if you don't pay on your mortgage. And yes, it's typically required. If you put less than 20% down, that was one of the things that they came out with was, okay, we won't make everybody put 20% down. The government will back these loans to keep them super low rate, but we're going to have this extra fee to help compensate the risk for the government side of things.
Right. How long does that stay on there? Is that forever? I buy a home, I get a 30-year fixed rate loan. How long does the PMI stay?
So it depends on a couple things. You can always refinance it at any time and get it removed with whatever loan program you go with. Depending on the loan program, it could drop off at 20%. It could be on forever. So that's going to be something that we're going to have to look at, when we're figuring out what loan program. One, what can you qualify for? Because we're always going to try to get you to conventional if possible. But again, if it's going to save you, the average person moves or refinances every 3 to 5 years. So I know, Mr. First-time home buyer millennial, you plan on staying here for 20 years.
My forever home.
You're going to stay. You're going to build a family here.
Yes,
it's going to happen.
Never moving.
Statistically, let's say you refinance. Let's just say you refinance. Then we're going to look at more of a shorter term option because statistically you're going to either refinance or sell this house. And if there's an extenuating circumstance where that really is, we'll get to know that with the buyer and we'll say, okay, let's look at this other loan strategy instead because this, you're an anomaly to this statistic, right? But for the most part, it can take anywhere from 2 to 3 years to drop off with the current market appreciation.
Okay, perfect. Now, what about, so I'm putting my 5% down, what if I got a second loan at 15% so I can bridge that and not have to pay PMI?
Yeah, so second lien, right?
Yeah. So
that's a question I get. So I'll answer the question, yes, it's possible. Yes, people ask me about it. 90% of the time, it's not the best option for the buyer, and they will actually save money by doing PMI on the loan versus a second lien. So it's kind of one of those things that sounds great in theory.
Okay.
Like, yeah, PMI, we don't want to pay PMI, it's terrible. Well, really, it's
what kind of interest rate are you going to be paying on that second?
It's really high. So it's over 6% typically. It's a shorter term. So instead of PMI, we're talking about, depending on your price range, maybe $100 a month.
Okay.
depending on how much you put down. So it's not a ton of money. I mean, it's $100. It's a lot. We're not talking about like $500 a month or something crazy.
I mean, it's $100 that you're lighting on fire every month,
which
nobody likes to do.
Nobody likes to do.
I love burning $100 bills.
But if you're paying $1,200 a rent, you're burning $1,200 a month.
Exactly.
So $100, buy a house now, build your equity and net worth, or $1,200 for.
We'll dive into that a little bit more because I do want to talk about rent versus buy here in a second.
Yeah.
But you would say with the 15% second lien, great on paper, in practice, in most situations, probably not going to be the best option.
Yeah, I do it a lot with higher net worth clients, with clients that are buyers that are maybe as a bridge loan, they're selling a house and they want an option to be able to not have to sell it. There's advantages to it. It has its place. But most of the time, unless people just really have a giant hatred for PMI aimlessly without reason, I typically don't recommend it.
Okay. So we just touched on rent versus buy. I want to get into that a little bit further. But let's talk about, we said timeline. So average person sells or refinances within 3 to 5 years. So I just got a job here in the area. And I know I'm going to be here for at least 3 years. This is going to be my territory for the next 3 years minimum. I might have to move after that. What is that point that it makes sense to buy versus to just say, I'm going to go ahead and get an apartment because I'm not sure where I'm going to be at in a few years? Where is that break-even point for most people? Let's stick around that, I'd say, entry price point $250. So I think that's going to be where most people are looking, especially with home prices where they are right now. That's going to be kind of your entry point. So where would be that point where, okay, it makes sense to buy versus renting?
Yeah, good question. So it really depends on how the loan is structured. A lot of my first-time home buyers, we know that up front, that statistically they're going to move every 3 to 5 years. And then also, depending on their market, let's say they're computer sales, and they have a history of moving every year. Okay, well, we're going to need to structure this loan really differently than your parents that are buying their forever house and staying there for 20 years, right? It's a totally different conversation. So for the most part, I mean, I would probably say there's a saying, and it's you don't lose money when you buy a house, you lose money when you sell a house, right? So there's actually more costs when you sell your house versus when you actually purchase a new home. So keeping that in mind, really we have to look at, the cost on the back end and foreseeing that. And I would probably say 2 years. If you plan on staying 2 years.
So your cost on the back end is selling, and this is where I need to keep the people from pitchforks and torches to come find my house. It's going to cost typically anywhere from about 7 to 7.25, primarily based on commissions. So that's going to be you get your commissions, and then you have about another 1 to 1.25% of title policy, attorney's fees, underwriting. I mean, you just all the fees that go along with selling a home. So yeah, it's going to be about 7 to 7.25 if you're paying full commissions. Could be slightly less, but that's kind of that number to work around to say, okay, I need at least that much appreciation to break even. So,
which, I mean, you're the real estate expert.
In this market right now, I mean, we've seen
last year. What was the appreciation?
13.5% in most areas.
Insane.
I mean, so you're seeing it in 1 year. Now, we're kind of seeing a shift in the market. I'm going to do a podcast on that down the road because prices are changing. We're kind of seeing the market slowing down, and again, that's going to be on price points. So I'll talk more about that later. So we're going to stay here on topic, but I want to, so really 2 years is kind of that, is that?
I'd say 2 years. My personal thought, now I bought our current house right now, and I had the best idea ever. First person ever to have this idea. I'm going to have my 2-year-old child and my wife who hates moving, and we're going to move every 12 months, and we're going to buy a bunch of investment properties.
You and me both. We're going to go in and fix it up and then turn around and make a ton of money.
Yeah, that was 3 years ago. I've done like 2 things to the house. So we all think we have a crystal ball. We think we know what's going to be next and how quickly we're going to move or what our job's going to entail. My recommendation is if you think you're probably going to be in the same general area for a couple of years. Take the plunge, buy a house. You won't regret it. We can always figure out a good way to make it work. Don't be scared of your timeline. Don't let that timeline prevent you from taking that first step.
Absolutely. That reminded me. Okay, so talking about jobs moving around, we have to backtrack a little bit. So I'm in sales, obviously. I'm in real estate, but I have buddies who sell software, who sell cars, who they're in sales. To apply for a loan, like I said, we're going to have to backtrack a little bit. Let's talk about what does that look like, your job, your income, because most people, obviously, the most money they have, we're not trust fund babies. We don't live off of capital gains. What career, how does that apply towards qualifying for a loan?
Yeah, so there's always exceptions. There's always ways to get to the finish line. So I don't want to disqualify anyone from saying anything. So if you don't fit in this box, that doesn't mean you can't get a house. It just means it's another conversation we have to have. So typically what lenders are looking for, again, Fannie Mae, Freddie Mac, what they're looking for is 2-year consistency. That's what you'll always see through employment. So what they figure is, man, that's great that you could go out and sell blenders to a bunch of restaurants for 6 months and you made $100,000. Was it luck? Was it you knew somebody? Is it going to run out? I mean, we can't use that based off of, to project what you're going to make for the next 30 years, right?
Exactly.
So what they figure is if you can do something for 2 years, you're going to be pretty good at it. It's going to stick, right? There's a pretty good chance. So they're looking for 2-year consistency throughout whatever you're doing, whether that's a specialty job, maybe you're a nurse. And obviously if you're a nurse, you don't have to be a nurse for 2 years, but you went to school for a really long time to be a nurse, right?
Yeah.
So we're going to use that schooling as your 2-year history in the field to show that you're qualified to do that job.
Okay.
If you are a $10 an hour cashier at Kroger, good for you. You're an unspecialized employee. You don't have to have a history. You just have to be there for a few months.
So a salary position.
Yeah.
I could take a new job and I have a guaranteed, this is my salary every single month and this is what I make a year. That can apply right off the bat.
Yeah, we'll say 6 months most of the time is where we want to see that. If you're any kind of a commission job, really ideally that any lender wants to see 2-year history with any commission, bonus, or overtime history.
Okay.
Because they're variable. There's exceptions to get you to the finish line with 12 months or sometimes 18 months. But 2 years in an ideal world is what mortgage lenders want to see. Okay.
So kind of the final point that I want to wrap up on, and this goes back to that kind of break-even point, rent versus buy. I have a lot of buddies who are renting right now, and they're spending $11, $12, $13, $14, $1,500 or more a month. And we have people in our office right now who have 2-bedroom apartments, and they're spending $2,200 in rent every month.
Crazy.
But I don't have to worry about fixing anything in that apartment. So on a month-to-month basis, I asked you to put this report together for me real quick. So we just compared, and we're going to have a blog that comes out along with this, and we're going to attach all that information. Of course, I'm going to put Shane's contact information in there, so if you guys have specific questions or comments or want to know a little bit more, feel free to reach out to him. But we're going to go ahead and link this in there. He prepared it with, like I said, Fairway Home Lending. We looked at what does it look like on a month-to-month basis if I were to go purchase a $200,000 home versus my rent right now at $1,250 at Lakeside or at the Shops of Legacy or Austin Ranch. That's where I'm living right now, and I'm spending $1,250 in rent. Thinking about buying, but I'm scared of commitment because millennials are so great with commitment. What does that look like? What is the price breakdown? And of course, we have the graphs and stuff on here. But Shane, can you kind of give us just a quick by the numbers on a month-to-month basis? What does that look like?
Yeah, and the conversation that Nash and I had prior to the call was Nash was saying, hey, pretty much exactly what he just said. When does it make sense to buy a house if you're renting? What does that look like? And prepared, it's called a total cost analysis on there, and basically it goes ridiculously in the weeds and shows you pretty much everything.
There's a lot of information.
Lots of graphs.
Lots of graphs.
Yeah, numbers.
If you're a numbers person, just
go to the blog.
Oh yeah, you're gonna love it.
So there's really two conversations that I have with somebody that's renting and trying to figure out, because buying a house isn't right for everybody.
Absolutely. I've told multiple clients, I don't know where I'm going to be at in a year. Don't buy.
Yeah.
Don't do it. It's just not. It's not a good idea.
Yeah. Or finishing up school in 6 months, I might go out of state.
Yeah. Or
yourself a disservice. Don't buy.
This job, I don't know what's going on with it.
Yeah.
Don't buy.
Yeah, for sure. And that's something we'll dive into on the call too. But essentially, there's two conversations. It's what is my cash flow? What is my monthly cash flow? So, and then what is my actual net monthly payment after the benefits of owning a home?
Okay. What benefits do I have?
So
besides obviously something that I'm paying money towards and owning, besides that, what money do I get back?
Yeah, there's three main benefits to owning a house. So you get tax write-offs for the portion of the mortgage is actually tax deductible. It's a pretty significant amount. I mean, we're talking at a $200,000 house, it comes out to about $200 a month. So $2,500 at the end of the year is what you will get back in your pocket. This is not reducing your taxable amount. This is money back in your pocket.
Yes, this isn't off that $50,000 income.
No.
It's not dropping me down to $47,500.
This is you got $500 back last year on your refund. Now you're getting a $3,000 check back. I mean, it's a pretty sizable amount. People discount that a lot. That's the number one benefit, I feel. Number two benefit is you're paying principal towards an investment. You are literally, instead of putting, let's say you pay, $300 per month into the principal of the house. That's money going into it. That's a savings account.
Yes, it's a forced savings account.
Yeah, exactly.
That's going to vest itself in 15 to 30 years, depending on...
Exactly. So the third and final thing is appreciation, which has been fantastic the past couple of years. We're all kidding ourselves if we say that it's not going to slow down.
It's going to go on forever.
Oh, man, I'd love to get 15% every year.
I would love that.
Yeah.
Except for the taxes part.
Yeah. So we're always going to appreciate. Historically, we've seen about a 3 to 5% appreciation in a healthy, normal market.
Yeah.
So in this estimate, I've used a 3% appreciation, which is on the way conservative side of things.
Yeah.
So did I answer that question though?
Yes.
Three benefits?
Yep.
Okay, great. So on here it shows you it is very, very beneficial from an investment standpoint to buy a house. So it goes on to show you basically, essentially what I'm showing is even if you buy a $200,000 house versus renting for $1,200 a month, if you look at with the tax benefits, the appreciation, and the principal paid into the house, you are saving over $200 a month by buying a house.
$200 a month.
$200 a month. That's without. Actually, I apologize. I lied. That's actually not with appreciation. That's just with principal and tax benefits. So you're saving $200 a month by buying a house, as long as you make sure that you're going to be in the area for more than 12 months. Right?
And that's compared to the $1,250 credits or
$1,200 a month for rent.
So if you're spending $1,500 a month, you're saving, $500-$600.
Exactly. Yeah. So now that's from an investment standpoint. That's bigger picture. That's honestly a lot of my first time home buyers.
They don't see it that way.
They don't see it that way unless I show them and really.
Well, this is your tax benefits. This is that check you're going to get back. I've loved owning a home. I've gotten money back every year from the IRS, which nothing feels better than getting money back from them.
Yeah, stick it to the man.
Stick it to the man.
So, but there's something to keep in mind. You do have to pay for the mortgage every month. You do have to pay the tax benefits or delayed gratification. That's at the end of the year.
You're not getting a $250 check every month that just says congratulations, Mr. Homeowner.
Exactly. Yeah. This is a bigger picture. This delayed gratification. Biggest delayed gratification is building your net worth in the house. That principal, you don't get that back till you sell the house, right? So something to keep in mind. Yes, up front you are going to pay more from a cash flow basis.
On a month-to-month basis, your payment will be more. Yes. So we figured it at $200,000. I'm going to just peek over here. Depending, of course, on what program you use, your payment's going to vary a little bit, depending on if you're going FHA. FHA with no closing costs versus conventional down payment. You're going to vary, looks like here, $1,470 on up to $1,575. So hard numbers on a month-to-month basis, you are spending $300 a month additional out of pocket
right.
when compared to that $1,250. But of all of those, your quote-unquote actual monthly payment after you factor in those tax rebates and whatnot, it's looking like what? $950 up to $1,050 hard costs.
$1,000, yeah.
So there is, you can't, I mean, you have to look at it as what are you paying out of pocket right up front versus what is the actual true benefit. So there's kind of a little bit of higher level investment talk whenever you start to really look at and break the numbers apart.
Yeah, and that's something that I want to be transparent about that, because that's not something that we want to, you're going to save money on a month-to-month basis by buying a house.
Absolutely not. No, you're probably going to be spending a little bit more. Yeah.
But it's going to be beneficial. The mic drop number that I want to put on, since we're finishing up the podcast here in a few minutes, your net worth over the next 7 years. Remember, the average person moves every 3 to 5 years. So let's say you're the average person, you move in 5 years. You are going to pay 5 years of renting $85,000. If you pay $1,200 a month, get out a calculator.
Yeah.
$1,200 times 60 months, right? 5 years is $85,000. Just your tax benefits alone in that house comes out to $13,000.
And that's a net to you.
Right. That's money back in your pocket. So if you look over 7 years, a little bit more long term, a 7-year period, if you rent for 7 years, guess what your net worth is?
Negative $85,000.
Yeah. Or zero.
Yeah.
Best case.
or zero. Yeah.
If you're staying with your roommates back at home.
Yeah.
Mom and dad, right? If it's zero. Or your net worth in 7 years of buying a house is $113,000 of 7 years. Just making your normal payments with 3% appreciation in the market.
Yeah, we're talking about almost a $200,000 swing.
Right.
If you were renting at $1,250 a month.
Right. Pretty insane.
Yeah, it's nuts.
Yeah. So this is all broken out in there. It's not smoke and mirrors. Take a look at that presentation. It'll show you exactly what that looks like.
Yeah, good stuff. Shane, I really appreciate it. Thank you, sir. Guys, we're going to have, like I said, a blog to go along with this. So if you guys don't like listening to our lovely voices, you can read some more of this information. We really went a little long on this, but hey, it was great information. If you guys have more questions, comment on here. Shoot me a message, shoot me an email. I'm going to have my contact information as well as Shane's. If you guys have specific questions, or if you're curious, hey, I went to quickenloans.com because I know Shane loves Quicken Loans.
Love Quicken.
They're so good. They promised me a super low payment. Guys, shop around. I know Shane's probably going to hate me for saying that, but get several opinions. I say it with real estate agents. I'll say it with mortgage. Shane is going to be great about being transparent and saying, here's why you're getting that great payment. I can or can't beat it, and here's the reasons why. Great wealth of knowledge here. I go to him anytime I have questions, not often because I have all the answers.
Typical millennial, yeah.
But yeah, please reach out to him if you have questions. Reach out to me if you have questions. I appreciate y'all's time, and I will see y'all next time.
Thanks, guys.
Have a good one.